Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. In this episode of the Wealthy Behavior Podcast, we're sharing a recap of one of our more popular educational, informative events that we do during the year, which is our 2024 Market Outlook webinar, featuring regular Wealthy Behavior Podcast guest host, Bob Weisse, Chief Investment Officer at Heritage Financial, and Brad Long, Chief Investment Officer from investment consultant Fiducient Advisors, talking about our expectations for stock and bond market returns in 2024, as well as other asset classes, and answering some questions that we've received in advance, timely based on what's going on in the market. I hope you enjoy the recording.
Hello, everyone, and welcome to the 2024 Heritage Market Outlook. I'm Bob Weisse, Chief Investment Officer at Heritage Financial, and I'm here today with Brad Long, the Chief Investment Officer at Fiducient Advisors. For those of you who don't know, Fiducient is an investment consultant that Heritage works with. And one of the main projects that we work on with Fiducient is capital market assumptions, which are long-term market forecasts and relate to market outlooks and our process for portfolio construction. And today, Brad is going to walk us through some slides relating to their recently released 2024 capital market assumptions. Before I hand it off to Brad, just quick Heritage Financial at a glance. About $2.5 billion in assets under management, clients in 36 states, 44 employees. Our mission statement that we live to every day is make a positive and lasting financial impact on the people in our lives and those we serve. So with that, Brad, I'll hand it over to you.
All right. Well, good morning and thanks, Bob. Appreciate it. We're going to go through pretty quickly a couple of quick things. First, we're going to look in the rearview mirror and talk a little bit about how we position portfolios. And I know Bob is going to follow through on, some of the things we did in calendar year 23. Turn our gaze to 2024, do a quick run through the economy, and then talk about our portfolio positioning and capital market assumptions. So starting a bit in the rearview mirror, looking at 2023, as we're sitting here kind of this time or even earlier in 2022, looking forward to 2022 or 2023, there was really three themes we thought would be driving markets. The first was persistent volatility, moderating inflation at a bear market bottom. And, at that time as well, if you remember, it was a period of time in which it was almost ubiquitous amongst economists and prognosticators. Hey, there's going to be recession in 2023. It's an inevitability. The question is when, not if. Here we are sitting in January of 24, and recession was certainly not in the cards for 2023. So what did the markets miss? It seems like probably that middle box there of moderating inflation is really what led heavily to, the market rally and a bear market bottom, and a lot of glad handing and backslapping at the Fed for success in moving inflation in the right direction. So as we move our gaze to 2024, we think there's a couple of key themes that are really going to be driving markets. The first theme is what we're calling the messy middle, right? So we've had the success of moving inflation from call it the 9% range in 22, down to the 3% range where we are today. Now, the last mile is always the hardest. That's moving from where we are today to the Fed's target of 2%. Without getting into too much detail, we think somewhat of the 2% is a misnomer, right? And somewhat of a false target. But nonetheless, we think that there's important inferences between this range of 2 and 5% of what that means to the Fed and Fed policy that could be moving rates lower. And we'll talk about more of that in a moment, and what it means to asset prices. The second is a little bit of a nod to that kind of inevitability of recession, materially shifting portfolios, and this idea of kind of prepare, not predict. One, we don't think anyone can really market time, so it remains futile, but we can build resilient portfolios that we think can weather potential volatility. And we'll talk more about where that volatility may be coming from. And speaking of that, concentrated consequences is our third theme. So this idea that, so much of the success of the headline S&P figures that we've seen in 2023 have really come from quite literally just a handful of stocks. They've been dubbed kind of the Magnificent Seven, if you've seen in the media. And, I read just an incredible stat the other day. So just these 7 securities. So just as a reminder, that's Apple, Amazon, Alphabet, Meta, which is Facebook, Nvidia, Tesla, and Microsoft, right? So almost on one hand. Just those 7 securities are larger than the combined market cap of all the companies in France, Japan, China, and the UK combined, which is just astounding, right? And look, they're incredible companies doing incredible things, but that's somewhat almost staggering and something we may not see again in history. So punching forward to where we'll be digging into each of these a little bit more in a moment, but just talking about on a net basis where are we most interested in 2024. So fixed income, we think can and will play a very interesting role in portfolios for 2024. It's certainly recharged relative to the last decade or so, where interest rates have been really punitive, very low forward-looking expectations. Now, frankly, we can own fixed income and expect to earn a reasonable rate of return, but we're also trying to dispel some of the fear that was created in 2022, which created, kind of duration or interest rate risk as a dirty word. We think in 2024 that could start to shift. And then this idea of very narrow leadership, right? Here in the United States with technology stocks, just a handful of securities that creates both opportunity and fragility. And so we'll talk a little bit about small cap stocks. We'll talk a little bit about global and international and kind of punch forward. But, we do, before we get into our portfolio allocations, part of the big conversation in 2023 was really the no-show of a recession. So we'll go through a quick economic outlook and just kind of set the tone and tenor of what we think that means for portfolios, and then dive into some of that portfolio positioning and Bob's updates. So first here on the no-show for 2023. So this is probably one of the graphs, one of a handful. There's probably a dozen or so that really tripped up economists. Economists constantly trying to peer into their crystal balls, look forward and say, what's coming down the pike. Well, leading economic indicators, right? LEI, as opposed to lagging economic indicators, which is kind of a rear view mirror, type data point, are ones that tend to be more predictive of future economic outcomes. And so, above zero, here you see economic expansion. The gray bars here are recession. And when these numbers are dropping and falling, you tend to see that preceding economic weakness. So a lot of economists in 2022 and 2023 were saying, hey, here it comes. Here comes the recession. It's an inevitability. And you can stack this up with many other data points, one of which we heard a lot about was the inverted yield curve. Yet here we stand in 2024, and 2023 is a very robust year. So what gives? Where did this go wrong? What gives is the consumer. The consumer well outspent expectations in 2023. And remember, 2/3 of the US economy is driven by consumption. And so, when you talk about the consumer, we naturally talk about jobs and we talk about, the labor market. And that has been one area that, remains robust. And there's no disagreement with that. There's certainly been a robust economic backdrop. We've seen real wages grow. We've seen unemployment remain extraordinarily low. But as we talk about what's important to allocations and trying to think about kind of driving, by looking forward, we need to think about what's a leading and lagging data. And so employment data, while it has been robust, is a classically lagged data. So I'll use the analogy of driving in a car, right? So lagged data is driving by looking in the rearview mirror. Coincident data is like kind of looking out the side view window. And leading economic data is, trying to look out the windshield and drive the car here. Well, what we're looking at is, looking back to 1948 and the non-farm payroll. So this is how you would judge employment. And you can see when you rewind the clock, 1, 2, 3 quarters or just prior to a recession, the employment position remains strong, right? So 3 quarters prior to a recession, you have 415,000 jobs on average created over the quarter. 2 quarters before, 267, and you see that slowly dip. All of a sudden, 1 quarter after, negative 213, negative 392, right? So those figures flip quickly. And it may come to surprise some, but it's because it's that lagged nature of data. So again, as we look at, kind of the previous chart, that's more of a, in the red, yellow, green light economy, right, of a stoplight. It's kind of a yellow light data chart. This on the employment basis, right, is telling us a bit more of a yellow light story as well. And so the chart we have up here is, instead of looking at just those figures, right, let's look at the trend of those figures. And again, trying to simplify this chart, anything above 0 is saying, hey, a little bit of a warning here. We're basically losing more jobs than we previously had. Anything below 0 is saying, hey, we're adding more jobs than we previously had. And so we have economic growth. Now, no perfect indicator of a potential recession exists. Frankly, if it did, we'd all just follow that. And, really, Bob and I wouldn't need to have a job. But as we look at these figures, right, they start to tell us, hey, again, in that red, yellow, green light framework, there's potential for economic weakness. So, in summary, as we look across the economy, just because a recession was a no-show in 2023 doesn't mean that the risks don't remain in 2024. But again, that's not something that as we build allocations, we're building portfolios, we're not trying to time recessions. But what it helps us do is helps us set tone and build probabilities around things that are important for our positioning and asset allocation. So obviously, economic weakness or strength is one of the things the Fed is focused on. Also, inflation is one of the things the Fed's focused on. And that helps them set their dual mandate, helps them set policy. So how accommodative or restrictive would they be? And that's a big conversation in the market right now is, what is the Fed going to be doing? Are they going to be increasing interest rates, decreasing interest rates, staying pat where they are today? So before we even start to have the discussion on what's the Fed going to do, we kind of have to figure out where they are today. What we're looking at here is the effective funds rate. So it's the Fed's policy rate less their favorite version of inflation. And it gives you a sense of how much their foot is on the gas or on the brake of the economy. So when the line is above 0 here, that means that their foot is on the brake. In the higher the line, the harder they're stepping on the brake. And when we're below the line, their foot's on the gas, right? They're trying to accelerate the economy. Now, the Marianas Trench, if you will, that deep fall in that line, that is both when the Fed was in a very accommodative position and inflation took off post-COVID. And then that rocket up, that is both the Fed in 2022, really chasing kind of their tail and being behind the curve on inflation, and inflation falling. So interest rates rising and inflation falling. So today, we have real rates that sit, in kind of the, call it, depending, because inflation has been moving, in the 2s or 3s. But since 1948, the average real rate from the Fed is about 1%. So even if we don't go into a recession, right, which is where a lot of this rate cut conversation happens, we could have something like a soft landing, right, where you have inflation moderate, you have unemployment, employment remains strong, and then economic growth continue. That's that classic soft landing. So as we look at this data cumulatively, right, this idea of the messy middle of inflation and kind of a range-bound scenario, we have that, call it, yellow light economy, certainly no guarantee of economic weakness, but certainly not kind of materially robust and growing. We think that develops multiple paths for the Fed potentially to move lower. And that has a lot of important inferences to us on assets we want to own, which assets, and how we position for 2024. The only other thing we'd mention here is kind of bottom right is, since in the fourth quarter, the market has really built up its expectations around a Fed cut happening in March. We would just kind of be leery of that and really, betting the farm there. Honestly, if you're looking for a rate cut, it probably already happened. The market's moved ahead of that idea, and the Fed is certainly leery of the idea of moving rates too early, because as we mentioned, the unemployment or the employment picture still remains strong. And so, they know that if they start cutting rates too early, the risk of inflation moving higher becomes much greater. And so they'll probably be more patient. But nonetheless, as we look to, overall, again, trying to get into this idea of prepare, not predict, but also just say, embrace the inevitable, right? Recessions, market volatility, those are a common part of markets. Recessions since 1950 have happened about every 6.5 years. And so I guess in theory, right, a recession is always coming. So we're never trying to bet or time whether it's coming or not. We're trying to position portfolios, based on current market outcomes. So with that, why don't we jump quickly into portfolio positioning? And then, Bob, I know we can certainly take questions along the way if they're coming in the queue, or we can get to them towards the end.
Yeah, just a reminder for our participants, you can use the Q&A function in Zoom, and we'll see the questions as they come in, and we'll answer them either at the end or as we go, depending on how they fit. Thank you.
Perfect. So, we give a bit of the punchline here on, our interest in fixed income, small caps and global. Here's a little bit more of the granular details, if you will, in which we'll get into, most, but not all of these subcomponents, just given the amount of time we have. So first is around fixed income. We mentioned, just fixed income in aggregate, right, is now an asset relative to the last decade that is far more attractive than it's been in a long time. It can provide resiliency to potential concerns or volatility and weakness. But not all fixed income is built alike. So we like kind of higher quality, intermediate duration fixed income at the expense of, which is something we very much liked last year, is high yield bonds. We just don't think that we're earning the same amount in those spaces. And frankly, there's a little bit more risk embedded there, which we'll get in just a moment. And then moving over to global equity, we still think there's a lot of opportunity here outside of just, not just a handful of securities or just U.S. technology, but just U.S. large cap stocks. So small cap, which we'll get into, non-U.S., et cetera. So why don't we punch into fixed income, because it's probably one of the bigger, call it, year over year opportunities. And, as we noted, we think there's multiple paths lower for the Fed to move interest rates lower. Now, could they move interest rates higher? Sure. But that would really be predicated on inflation accelerating, probably above 4%, maybe even 5% for them to really get back on that horse. So the left side of this graph is what, different tenors of fixed income look like if interest rates rise. The right side of this graph is what potential returns look like if interest rates fall. So the middle bar here is the Barclays US aggregate. Let's call it the S&P of fixed income. Now, if interest rates fall by call it 100 basis points, that could mean a potential total return of over 10% or a double-digit return on fixed income. So that's an equity-like return with a high-quality, lower volatility asset. So that is something that we're interested in, where we can build return into the portfolio without having to take on more risk. And just to give a sense of kind of the coil that's in that spring, so Bob, if you moved slightly forward here. So, in the fourth quarter alone, right, interest rates, the expectations around interest rates shifted and interest rates started to fall. So the Bloomberg Ag returned 6.8 in the fourth quarter alone. Now cash, which has kind of been the cash versus bonds, mantra of 23, returned 1.4%. So it was also positive, but almost a 5.4% outperformance in just the fourth quarter. So you can get a sense of kind of the potential coil that's in that spring, that if the Fed were to cut, what that could mean to fixed income. And just to give some historical context, in a soft landing scenario, the Fed could move maybe 50 or 75 basis points, and if you have more of a typical recession, the Fed could cut as much as, call it, 250 basis points over 18 months. So there's, a lot of potential for movement there. Now, conversely, across high yield, high yield has been a great asset. It's been one that we've owned in portfolios and has been beneficial. But, today where it's priced, it's just less attractive, which is fine, right? As the facts change, our opinions change. And so the line you're looking at here is what's called the spread of high yield. So it's basically the percentage or the yield above what's considered risk-free, which is the treasury. Now, we can debate if that's a risk-free asset or not. That's a conversation for another day. But today, you're only earning, call it 3.25. So that's the 323 above the risk-free rate. Historically, if you look at, when rates were around that level, actually investing in high yield underperformed higher quality bonds by about 2% on an annualized basis 3 years forward. Now, if you were to say, well, it's not just exactly where it is today, it's going to bounce around between there and average, which is about, just under 4, 472. And Bob, if you advance just slightly, the stats will pull up on the bottom here. You would actually, just barely outperform, but probably not, to a level interesting enough to take on that additional risk. Now, conversely, where we start to get really interested, where spreads are around 600 or so, the outperformance there of high yield is almost 5.5 on a 3 year forward basis. So again, it's more of as the facts change, our opinion changes, and we try to lean into things where we think opportunity presents itself. And today, high yield is just a bit more rich, and so our interest lies more on the investment grade side, which we just discussed. Now, as we move a bit to small caps and U.S. equities here, it's been a pretty interesting run for small caps. So if you were to orient, I know there's a lot going on in this chart. So if you were to orient around kind of the 0 line in the middle of this chart, that's to show you a kind of a typical bear market bottom. In this data really goes back. Let's see, to the 1997 or no, 1987. And it shows kind of the path of returns for small caps following a bear market bottom. Well, you can see this, line that's bumping along the bottom here is our current path, which is, small caps have really not rallied since the October low of 2022, where on average, you see that kind of dark line across the middle. It has, on average moved up, and there's a lot of daylight in between those two. Part of that is the makeup small caps, and part of that has been the incredible success of large caps. So if we unpack that a little bit more, we think there's a lot of reasons that small caps are interesting today. One, it's not just valuation. Small caps are certainly trading at a valuation, but it's also around the composition. So as we talk about concentrated consequences, right? So the handful of securities, largely U.S. large cap growth or technology-oriented securities. The S&P 500, about a third of that index is made up of technology stocks today. Simply by owning something other than the S&P, like small caps, we're actually diversifying our exposure and owning many other sectors that haven't benefited as much in the recent rally. We think that can certainly add, a lot of additional, potential in portfolios. But speaking of valuation, right? So the Mag 7, those 7 securities on average up over 100% in 2023. If we look at large growth, and we're picking on large growth because that's really where the Mag 7, most of them live. They're a technology, most in the technology sector. That cohort of large growth trades at 140%, so above its 20-year valuation. So they traded about 26.5 versus their 20-year valuation of 19. Now, that's obviously, so they're expensive. And in some ways you could say, well, maybe they're worth it. The only other thing I'd mention there is that's been an expensive 20 years, right? The last 15 years, large growth has had a lot of success. So it's not as if we're comparing this to a period in time in which large cap growth materially underperformed, and now it looks expensive. It looks expensive because it is expensive. Now, also, as we talk about the S&P, we own large cap in our portfolios. So it is important to break down the S&P into some of those sub cohorts. So if you look at just the top 10 stocks in the S&P, which 7 of which are made in the Mag 7, they traded about 27 times. So that's expensive relative to the rest of S&P, which trades at about 17 times. So there is kind of still opportunity in the S&P. It's just hard to kind of out earn those higher multiples. And so as we're building a diversified and robust portfolio, we want to make sure that we're kind of taking advantage of some of those discrepancies.
And so Brad, on this chart, we didn't include the legend. Dark blue is large cap and the lighter blue is small cap. Is that correct?
That's exactly right.
Question just came in on that. Thank you.
Yeah, sorry about that. Yeah, the large cap is the S&P 500 and the light blue is small cap, which is proxied by the Russell 2000. So maybe in summary quickly, just so we can also jump to questions here on the next slide. So, in positioning from kind of year over year, from 23 to 24. So high quality fixed income, certainly of interest. We discussed kind of the rationale why there, not just current yields being attractive, but also the opportunity for multiple paths lower and a fairly benign inflation environment creates a lot of interest there. The second, underweight high yield credit. We talked about, just being compensated for the risk that you're taking. And if you're not being compensated for that risk, then don't take that risk. And so, having our opinions change to some degree as the facts change and the opportunity set changes. The third, maintaining or overweight to small caps. So we just discussed, hey, there's an opportunity there, not just by rotating from kind of a concentrated sector perspective and owning just a lot of U.S. technology stocks, but on a relative valuation basis. We certainly think that there still is compelling opportunity there. Fourth, maintaining our weight to non-U.S. We didn't really get into that here, which we can if we'd like to, mostly based on time. But this notion of hey, the United States has been the preeminent market from a return perspective. Now 15 or more years running post GFC. Will that maintain as if history remains a precedent? It certainly won't, but that's not a thing we can time in a quarter or a year. But we do think that there are a lot of opportunities remaining outside the United States. And then the final, getting back to that kind of component of humility and market timing, we can build a portfolio that we think can, prepare us for whatever may lie ahead. Could there be a recession in 24? Potentially, right? As we went through some of the kind of yellow light economy statistics, but it's not something we have to predict, right? Rather, we would use the opportunity to take advantage of some of the relative valuation that we see existing, the yields within fixed income, kind of build that high quality and robust portfolio where we're not reliant on trying to time markets. So I know we got a couple of other things, Bob, that we want to cover. If you do, we could probably jump over these and we could jump straight into some of the updates if you'd want, Bob.
Yeah, let's just run through these quickly at a high level.
Okay.
I think this
so as a very quick reminder, so as Bob mentioned, we work with Heritage to help build 10-year forward-looking market forecasts. So these are the year-over-year changes here. And so you can see across U.S. equity, international, emerging, largely going down, across the equity cohort, a little bit more outside the United States, but still over the long term, we think higher and compelling opportunity. Across the real assets cohort, actually increasing here. So even though we think inflation would be range bound, especially given some of the subcomponents of these assets that underperformed in 23, it remains kind of a compelling environment for real assets. And again, kind of that rocky road or the last mile is the hardest. There's a lot of things in the mix that could easily help inflation accelerate, and having exposure to these in their intermediate term may help. For those of you all that own, alternatives like marketable alternatives or hedge funds or private equity, a lot of compelling opportunity, especially in the back of volatility. And then, going forward, one more page here, across fixed income, we noted, hey, a compelling opportunity remaining for a whole host of reasons. Now, again, even though our high yield bond forecast here is going up, most of the reason that's going up is because interest rates have gone up and treasuries have gone up, but the compensation for taking on that additional risk has gone down. So as you kind of roll all that into the soup, that's what gives you kind of your year-over-year changes. So in short, equity dipping slightly, fixed income increasing, alternatives remain compelling, as do real assets. And those are inputs that help set allocations that thoughtfully build into portfolios and plans.
Thanks, Brad. So transitioning into Heritage client portfolios, how did we navigate 2023? We went into 2023 aggressively, excited about prospective stock returns. So at the beginning of the year, or in late 2022, we increased the stock allocation for most clients and increased the bond allocation a little bit, but overall dialed up risk. And then as the year went on, stocks started the year off pretty strong. By mid-year, they were up double digits. So we started to rebalance back to a more normal position. And in doing so, for a second time, we added to bonds. And then later in the year, in Q4 of 2023, we started to trim real assets. I should say, again, trimmed real assets. We did that earlier in the year too, to add to stocks and bonds. But in private markets where we think valuations have held up much better than public markets, we trimmed real assets, and that mostly went to bonds. So over the course of 2023, we added to bonds on a number of occasions, so that we're starting 2024 more cautiously positioned with a healthy fixed income allocation. So if there's maybe one main takeaway from the slides that Brad went over and from our points, it's that if you're to look at your portfolio once a year, say January 1st, 2023, and then January 17th, 2024, as far as changes that one should consider, it's leaning into bonds a little bit more because yields have gone up. As you saw on the capital market assumption slide, all the bond returns are up. And then on the stock side, stock returns are down. So it's just shifting the weights just a little bit, a few percentage move from stocks to bonds. And then to get a little bit more granular, this is looking at value and growth investing. So in the US market, we have a number of different lines here. This gray line is the price to book ratio of the US growth index. And you can see it's up here, close to 10. And what's interesting is if you look, it's actually higher than it was at the tech bubble in 1999 or early 2000. So other than right around 2020 when valuation spiked, we're near all-time highs in growth stocks. And then down below you have the valuation of value stocks, which is pretty low as value stocks normally trade. But the spread between the two, so subtracting growth minus value, you see it's above the long-term average, the orange line here, and it's above the 10-year average here. So in the US, growth looks expensive relative to value. Now, looking at emerging market equity through the same lens, there's actually a different conclusion. So here you see the growth value spread. I'll just jump to the blue line, and you can see it was high back around 2019, 2020, so value was cheap. And emerging market value has outperformed emerging market growth by a good amount over the last 3 years. And as such, the spread has come down. So now it's below the 10-year average and closer to the long-term average. So as far as a takeaway and something we're doing in client portfolios as a result of this, we are in US maintaining positioning, tilting towards value stocks rather than growth stocks, tilting towards small cap stocks that Brad mentioned. In emerging markets, we had been overweight in value stocks, and we're reducing value and increasing growth. So bringing more value growth balance in emerging markets. Now that value's performed so well for the last 3 years in emerging markets. So that's something a little more granular that we'll be doing. As a reminder, the Q&A function's available, and we do have some questions that we'll get to. And there's a number of resources on our website. We have a Heritage blog, there's webinars, videos, our Wealthy Behavior podcast. We have typically 2 podcast episodes a month, so a ton of information on our website. And if you're interested in working with us or learning more about Heritage, you can contact us a number of ways, such as emailing us at letstalk@heritagefinancial.net, or phone numbers on the screen. So moving on to Q&A, we have some questions that have come in. Thoughts on commercial real estate market and their investors/banks. Brad, you want to take that one?
Sure, let me come off mute. Yeah, I think this is it's certainly been a big topic of conversation since kind of the mix-up of post-COVID. And I think when most speak about commercial real estate, they're probably in concern. They're more acutely speaking about office, right? Because commercial real estate is a very diverse and wide set of businesses, right? But if the question is more specifically geared towards office, there's no question office is struggling. The amount of supply that's come online, the demand mostly from the reshift in orientation of individuals going into the office and the frequency of which they're attending, and then also what that means to the per square foot you need per employee and how often they're coming in. That being said, when you actually start to dig into, because office as a percentage of commercial real estate in total is only about 16%. And then if you look at, office in particular and the debt that's coming due, because you mentioned, I think the question linked to banks, only 4.2% of that debt is actually maturing in the calendar year 2024. So don't get me wrong, office is probably going to be a little bit like the regional malls of the next 10 years, right? Office has to figure out a new home and what to do. But is it going to be this kind of catastrophic event that all of a sudden creeps up and blows up? Probably not. So, I think it's important to proportion the potential issue and not commingle office with commercial real estate, which is a big, vast, diversified group of properties.
Yeah, thanks, Brad. I think you're right. The person asking the question was probably thinking about office, but on the flip side, I like to remind clients that in commercial real estate, you have multifamily, which are apartments, and multifamily's done well because if you think about single family homes, prices have gone up a lot and people have to live somewhere. So apartments have done well. And then industrial and commercial, that's also done well. So that's like warehouses. If you think about e-commerce, Amazon fulfillment centers, that's a booming area in real estate. So commercial real estate really is mixed with office and retail being on the weaker end, and then industrial and multifamily, also life sciences have been really strong. We have another question here about election year potential outcomes, as well as emerging conflicts in the Middle East and Ukraine. Are those factored into the CMAs? If not, how do you feel historically this may affect the US/global economy?
Yeah, so it is factored in. So coming into 2023, actually, so this would be rewinding the clock to 2022. So remember, Russia had just invaded Ukraine. We had the first, ground war in Europe we've seen since World War II. You can see, note, international equity includes a 15% haircut implemented in 2022. That was on the basis of kind of the rising geopolitical risks, associated really around the globe. But at the time that was acutely in Europe. Now we have an expanding and potential conflict, additional conflict in the Middle East, which is also moving beyond those borders and into international waters, as we've seen with the Suez Canal and the Straits of Hormuz. So, it is included in there. That being said, this is not the first time there has been conflict, either in a military, geopolitical, or other sense. We've been through many wars. We've been through many trade tariffs and geopolitical tensions, and markets ebb and flow throughout, right? So it's a potential and acute concern, but it's not one that has tended to kind of overwhelm the direction or potential opportunity. So it's more of a on the edge item than it is in the driver's seat.
Okay, thank you. And just moving on to some questions that were submitted in advance. What impact does the Fed have in your views for the short term, 1 to 3 years, for the stock and bond markets? A little trickier, I know, making short-term forecasts.
Yeah, look, the Fed has been the game in town in the last couple of years. So inflation is the driving hand of the Fed. And the Fed has been kind of a driving hand in markets. It was the primary driver of prices in 2022, and almost mostly the speculation of what the Fed would be or be doing was a primary driver in 2023. Now, the Fed is an important factor, and we mentioned we probably dedicated 10% of our discussion today to the Fed and multiple paths lower and decreasing interest rates and what that means to fixed income and equities. So it's important, but we also don't want to put too much focus on just the Fed, especially for stocks, right? Earnings matter. Abilities for companies to generate revenue and have an expense structure that actually creates positive economic value, that matters over time. Earnings expectations for 2024 are earnings growth of about 12%. That's a pretty rosy picture from the sell side, maybe a little too rosy, which we could get into at another point. But the Fed is important. They kind of, let's call it, they set the tone, and they have a very direct and acute impact on fixed income and a indirect impact on equities. but they're not the only game in town when it comes to the 1 or 3 year forecasts.
Thanks, Brad. Maybe one last question, unless any more come in. It says, should I convert my traditional IRA to a Roth before retirement age? I'm 63 years old now. What are the potential benefits? So I'll take this one, and we need more information. I can't give advice with that, but just in general, doing Roth conversions can make sense for individuals, especially in what you call gap years. So in your working years where you have a W-2 paycheck, you might be in a mid to high tax bracket. Then if you retire on the earlier side, you'll have years of lower income before you start collecting Social Security and taking IRA distributions, required minimum distributions. So in those gap years where your taxable income is very low, a planning strategy is to convert the IRA into a Roth IRA. And the Roth bucket's nice because you never pay taxes on it. And at Heritage, we have financial planning software that'll project out every year for the rest of your life, and we'll optimize around that. And it's really a two-part question. Should I do it? And then if so, how much should I convert each year? So that's something we help clients with all the time. So I'd encourage the participant who asked that to reach out to someone. And one more question came in. Any thoughts on the potential impact of the election, either with the same or new presidential result?
So
that one.
Yeah, so presidential elections, statistically, the years of presidential elections, there tend to be slight, and when I'm saying slight, I mean less than 1% underperformance relative to other years. The rationale is really markets dislike uncertainty, and change is almost by definition uncertainty, right? So who takes the big seat, in the executive branch? When it comes to who fills that seat, and now I'm just talking about markets, I'm not talking about political views or other important social issues. Markets, frankly, again, they dislike uncertainty. So the best outcome for markets is one party controls the executive branch, the other party controls the legislative branch, and that minimizes the opportunity for material change, unexpected change. Say, totally new tax policy or totally new monetary or fiscal regime, right? So it removes some of those variables. Now, if it's red and blue or blue and red, there's really not all that much material difference, again, with just market outcomes. So, could it be a little bit more bumpy because it's an election year? Absolutely. But is it like all that predictive? Certainly not. And then, by the way, predicting elections, like, it's hard enough to get markets right. Ask any pollster about Trump's 2016 election, and they would tell you, it takes a little bit of humility to try to predict elections as well. So, we're certainly not in that game.
Yep, thanks, Brad. A couple more questions came in. One about small caps, and just summarizing it, it's there's higher volatility in small caps, and so, and our response to that is yes, we agree there is higher volatility in small caps, and therefore it makes up a small percentage of the U.S. equity allocation. So we still recommend the majority of one's equity allocation be in large cap stocks, but it just have some exposure to small cap stocks, as opposed to, say, putting your entire U.S. equity allocation into the S&P 500, so you'd have no exposure. So the minority, but have some exposure to small caps, because one of the reasons being there is more risk there. And then could be a similar response to the Middle East conflicts. What are the thoughts on the decline of the dollar and BRICS?
So, the direction of the dollar, one kind of matters what you're comparing it to, right? Are we comparing it to the euro, the yen, or just the dollar in aggregate, or maybe just versus Brazil, Russia, India, China, the BRIC cohort? All else equal, the direction of the dollar is probably most dependent on relative rates, right? And so if interest rates are high in one country and low in another, the strength of that currency tends to be higher. And inflation is a very important component of the potential strength or weakness of the dollar. And then probably thirdly, you would have some kind of political and policy components in there. The globe has been enjoying moderating inflation post-COVID, right? So obviously we had a huge spike Some of that, the dirty word of transitory, the Fed really regretted using that word, but ultimately it proved to be correct. With supply shocks and anomalous things that you wouldn't expect to be a repeat. Some of that more structural. But the U.S. has been ahead of the curve in falling inflation, especially relative, even to Europe, but even other parts of Europe, so Latin America or parts of Asia. So all else equal, this is a really big and broad statement. That would mean that the dollar could actually show some weakness in 2024. Now, again, currencies ebb and flow. That's not necessarily it's not a bad thing. The dollar's been extraordinarily strong since 2008 or end of 2008, beginning of 2009. So all else equal, if you saw some dollar weakness, that would actually disproportionately benefit investments outside of the United States, so international equity, emerging market equity, et cetera. But that's a pretty convoluted, really depends on what currency you're comparing it to. But in general, you'd say there's potential for dollar weakness in the forecast.
Oh, well, good answer. I think with that, we'll conclude today's 2024 market outlook. Thank you, Brad. We appreciate you joining and sharing your insights. And thank you to our participants for joining and for our clients for your loyalty to Heritage. Thank you, everyone.
All right. Thanks all.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.